Imagine you are a successful Ugandan farmer. You have just harvested 50 heavy bunches of matoke. You are wealthy in crops, but to actually live your life, you need to pay your child's school fees, buy a pair of shoes, and get some salt. This diagram shows the core problem of a barter economy. You have to find a shoemaker who specifically wants your matoke in exchange for their shoes. If they happen to want a pen instead, the trade fails entirely. Economists call this frustrating roadblock the double coincidence of wants. Even if you find a willing trading partner, you run into physical limitations. You cannot chop a live cow in half if you only need a small packet of salt. And if you wait too long to find a buyer, your matoke will rot, wiping out your wealth completely. Relying strictly on trading physical goods creates massive friction. It makes basic transactions exhausting and puts a hard limit on how much a local economy can grow. To eliminate this friction, humans invented a dedicated tool: money. By agreeing on a universal medium of exchange, a farmer can quickly sell their crops for cash and then use that cash to buy shoes from anyone. This timeline traces how that tool evolved to become faster and lighter. We started by bartering heavy goods, moved to commodity money like cowrie shells, advanced to printed paper banknotes, and now transact instantly with digital mobile money. As you can see with these crisp Ugandan shillings, modern money performs two other vital jobs. It acts as a precise measure of value, putting a clear, universal price tag on an item, and it serves as a store of value. You can keep a 50,000 shilling note in a lockbox for a year, and it will never rot. Once money made trading efficient, businesses started generating immense amounts of it. People needed secure places to keep their cash safe, borrow capital to expand, and transfer funds across the country. That physical need created the modern financial institution. This pyramid maps out the vast system required to manage Uganda's money supply. Let's break down how capital moves through the hierarchy. At the very top sits the Bank of Uganda. A common misconception is that you can walk in and open a personal savings account here. You cannot. It is strictly the central bank. It prints the currency, controls the national economy, and serves only the government and other commercial banks. The middle tier holds our commercial banks. These are profit-driven businesses, like Centerni or Stanbic. They accept deposits, offer checking accounts, and provide large loans to the general public and major corporations. Down at the wide base, we find microfinance institutions. They are designed specifically to support low-income earners, local farmers, and small business owners who need flexible loans but lack the expensive collateral, like land titles, demanded by commercial banks. A thriving national economy relies on all three of these tiers operating together, pumping capital from the central government all the way down to the village market. When a business owner scales up and starts interacting with commercial banks, they typically open a current account. This allows them to securely pay their suppliers without carrying briefcases of cash. The main tool they use to do this is the physical check. This piece of paper is a strict, highly coded set of instructions directed to the bank. To function, it requires specific data points: the date at the top right, the designated recipient on the payee line, your authorizing signature at the bottom, and a unique routing code printed along the bottom edge. You will also notice the financial amount must be written twice, once in numbers and once in words. This prevents a very specific type of fraud. If you only use numbers, a thief can easily alter 10,000 shillings into 110,000 just by slipping an extra 1 into the box. However, altering a handwritten English sentence is incredibly difficult to do without a bank teller noticing the forgery. This built-in redundancy acts as an uncrackable security layer. Let's put this into practice. You need to securely pay 20,000 shillings to a supplier named Musa Kagwa. Pause the video now and point to exactly where his name and the numbers must go. Musa's name goes on the pay line, and the amount sits securely inside the figures box. To lock that payment down, you spell out 20,000 shillings only on the word line. Adding the word only ensures no one can squeeze extra text onto the end. By accurately executing these details, you ensure your business capital remains entirely under your control. Physical commercial banks offer massive resources, but accessing them means traveling long distances and waiting in queues. Modern business often requires instant execution. That requirement drove the rise of electronic banking. Tools like mobile money and ATMs make financial transactions available 24 hours a day. Operating primarily through mobile phones, e-banking completely bypasses the need to build expensive physical bank branches, pushing financial access deep into rural, previously unbanked villages. But removing the physical bank branch also removes the security guards and the bank tellers. You are exposed to new risks, from system network failures to sophisticated cyber fraud, where conmen try to manipulate you into revealing your PIN over the phone. E-banking delivers incredible speed, but it demands that the user become their own first line of defense. Money acts as the true lifeblood of business, and our financial institutions serve as the heart, pumping that capital across the nation to keep trade moving. Here is a unified breakdown of how that system works. It covers the evolution of our currency, the structure of the Ugandan banking pyramid, and the core jobs money performs. Take a screenshot of this master cheat sheet for your notes. Whether you are carefully writing out a paper check to a supplier, securing a microfinance loan to stock your shelves, or transferring funds instantly via mobile money, mastering these tools ensures your business will operate smoothly and profitably in the modern economy.